Okay, now the exciting part, trading strategies around large orders. The objective when you observe these large orders is to front run genuine large orders for an highly leveraged profit. We have some of our traders here at Axia Futures who will observe large orders in some very thick liquid markets, and what they try and do is they have a one tick risk and a one tick reward, but they're doing it with such large size. For example, in the treasury market, if they see a 4,000 genuine order, 4,000 lot genuine order, and with that 4,000 lots that they then execute a front run trade just above it, they're looking for one tick, and they'll do it with a 200-300 lots sometimes just for that one tick. And so it's a very highly leveraged trade, provided your experience and your ability to interpret what is a genuine large order and what is not. Your ability to interpret that will determine the success of your trade, and that's only a process of observation and experience and solid deliberate learning. Now we're going to be looking at a couple of strategies in the next slide on some videos, but we're going to be looking at some front-running strategies, and the main ones really is, as I mentioned before, the explosive one-tick front run. It's the fill and run. So the moment you see that large order, so for example on the previous slide we saw that 2,000 lot, the moment that comes in, you determine that's a genuine order. You place a bid directly above it. The moment you get filled, you get out for a tick or 3 ticks, and so really the mathematics of that trade is you leveraging your size in order to get the full, given the type of liquidity environment that you have. And a lot of times large orders come in when the market's in that high state of panic, and the moment you see it, sometimes large orders start chasing the book up the page, and you'll get it sometimes when there's an OPEC breaking meeting on crude oil, when all of a sudden you see a large order coming to the market, 1,000 lot, and what you do, you place an order just above it. So 1,000 lot comes in on the buy side, you place an order just above it, and then you get filled and the market moves up, then all of a sudden the 1,000 lot is not being filled, it chases up the market again, it's not getting filled, so you run in front of that order. Sometimes you can get a quick 20 tick move when you notice a large order not being filled. Those are sometimes the best trades when a large order excuse me, is not being filled. And then there's the front run positioner after a fast sprint. We won't be looking at a video. I'd rather let you find this in the marketplace, but effectively what that is if you've had a large order sitting at a particular price all day and therefore kind of ticks the box of a genuine order, what you're effectively looking for is if you see the market moving 60 ticks, say in this instance in the oil market, moving incredibly quickly towards an order. If that market is moving very quickly towards a large order, there's a very strong likelihood that the market will bounce directly off that large order, because it's not moving towards slowly, it's not building time above that large order, because the moment you build time, there is a lot of energy for the market to trade through it, because it's building a good structure above it. So when a market almost vacuums towards the level, moves fast, it's easier to bounce because it's moving from far, whereas when it's moving slowly towards it and builds above it, it's not going to bounce as quickly because it's not bouncing from far, it's bouncing from close. So those fast sprint large order trades are some of they don't exist too often, but when you observe them, they are great trading strategies and high probability plays. And then there's the hiding behind the elephant trade. So once the large order has been identified and the large order, the front run starts failing, and all of a sudden you start seeing participants hitting that large order, or that large order starts disintegrating with trades that are going through it. The moment you see the large order just about to disappear, you have to react quickly enough by, in this instance, say if the large order is a 2,000 lot sitting at a bid at 50, the market is bouncing off it, but eventually the market starts trading out that large order. The moment it trades out, the market blips down. The moment it blips down, on the balance probability, what happens is it blips down because everyone's having to start covering who are front running. It blips down, and then you have to wait until you find that first little absorption zone, which we'll be talking on the later on in the module. The moment the market blips down and you see the market starting to reload on the buy side, you hide behind that large order, you bid it, and then invariably the market retests where that large order was taken out. So that's called the hiding behind the elephant, and we'll be looking at in the next video after this slide. And then you can get synthetic scalps via TT. You can have more automated strategies, such as you can have the same type of hiding behind the elephant, or if you hit the large order. So for example, if you're looking to hit the large order and the large order disappears, and the market blips down, as soon as you hit that large order, as soon as you get filled, you have an automatic exit. So the moment you get filled, you put an automatic exit for that quick fill, because the market can react very, very quickly. And that we'll talk about the hit and run plus a quick synthetic exit. So the hit and run strategy is you observe the large order. The people are unable to front run the large order. The large order is now being traded out. You join as that large order gets taken out. You follow that large order, and we'll be looking at in the next video, the video analysis of the ladder of a large order hit and run strategy. And as that large order gets taken out, it blips down. But this will make a lot more sense when we look at the ladder video next.